Good afternoon, and welcome to this next installment of the IBRN Lunch and Learn. And for this installment, we're going to be talking about when you can't pay your business loan. My name is Robin Wang, and I'm a capital advisor with Vibrant Future, and we provide capital advising services to businesses in the Portland, Oregon area, providing some guidance to help businesses secure the type of capital they need to grow and thrive. So today, in today's agenda, we're going to talk about what happens when you can't pay your business loans. That's a thought that has probably crossed many business owners who have considered getting a business loan and may refrain from getting a loan because they're concerned about, the possibility of not being able to pay the loan. And while that is a very possible, outcome, we're going to talk today about, what things you can do to mitigate that risk and to how to best navigate that situation should you one day get a loan and may encounter some problems in paying that loan. So we'll start off by talking a little bit about the loan agreement and then walk through the process. What happens when you can't pay the loan? It starts with delinquency to default, and then go through a little bit about what you can do or what you can do or what you should not do when you encounter this problem. And then we'll wrap up with just an overview of the capital advising services that I offer to businesses. So with all that, we'll start off with the loan agreement. The loan agreement is the key thing that kind of dictates what a lender can and can't do when if you're not able to make your loan payments. So the loan agreement, contains a couple clauses, kind of at a high level. It includes, the borrower's requirements. If you're borrowing money, it talks about what are you required to do? What are your obligations? And oftentimes that will include payment terms. Maybe you have to pay a monthly payment every month. It includes, what collateral you may have to offer. It may include timeframes. It may include, financial reports that you have to submit to the lender. It may include, financial terms, financial statistics or ratios that you're obligated to kind of continue to meet as long as you're borrowing the money. But then it also defines the conditions that constitute a default. A default is essentially when a bank says or lender says, we're going to declare default because you are not honoring your terms of the agreement. And there are a couple things that can constitute a default. The one that most people pay attention to is the biggest one is not making the scheduled loan payments. If you don't make a loan payment, on time, the lender could declare a default. A lender could declare a default if there are material or significant changes to your business or the collateral that you may have put up to support the loan. A default may be if the financial health of your business or organization becomes poor or riskier. So maybe certain financial ratios are no longer met, or maybe you have taken on too much debt, or maybe you don't have enough profitability. If your business is not financially healthy enough, a lender can declare default. And then other obligations that you may have that is listed in the loan agreement. If you don't report, if you don't have a certain degree of operations, if you don't have other compliance, requirements, whatever is in the loan agreement, if you're not meeting those obligations, the loan agreement will probably allow the lender to declare a default. And what happens when a loan is declared a default is that it says that the lender has options or recourse when a default is declared. And there's many things that are often listed in the loan agreement that states what a lender can do. Some of the common ones are the lender can call the loan, meaning that they can demand immediate repayment of all outstanding balances of the loan. So maybe you had a 3-year term loan that called for $100 per month, payable every month. But if they declare default, they're going to say, well, you still owe us $3,500 and we want that payment now immediately. So they can call the loan. They could send the loan to a collections agency and have a third party try to collect on the loan. They can institute or initiate legal action, pursue legal action against your business or whatever was dictated in the loan agreement. They may be able to garnish funds. Whether it's from another employer that you may have, from the bank account that you have, if it's with the bank account is with the same organization as a lender. They may be able to garnish funds from your customers through legal action. So that is something that might be available. They could seize and liquidate collateral. So if you pledged a car as collateral, they declare default, they can go ahead and say, hey, we're going to repossess the car and seize it, and then sell it at auction and use whatever proceeds we get towards repaying the loan. And if there's any left over, then they'll send the excess to you. So they can seize and liquidate collateral, and that collateral could also include receivables. They could go to your customers and say, hey, instead of paying your company, we have a court order where you have to write that check to us. Or they can invoke guarantees, whether it's a personal guarantee that you have forcing you personally to repay the loan, or a third-party guarantee, such as the U.S. government. The SBA offers loan guarantees, and when they declare a fault, they can tell the SBA, hey, this loan is in default. We'd like to invoke the guarantee that you have pledged for this loan. Now, none of those outcomes are desirable. And whether a lender will pursue all of these or not is a big TBD. It's depending on the approach to the lender, the relationship with you, and kind of what their policies are when a default is declared. So before we talk about how to navigate that process, let's talk about a moment about what the delinquency and default process might be. The first step in the process is a past due. And so past due happens when your payment is anywhere from 1 day to 30 days late. Again, this might vary a little bit from lender to lender, but in general, these are 30-day processes. So when a loan is past due, anywhere from 1 to 30 days, the lender can do nothing. Sometimes they don't do anything. Most of the time, they'll send you an alert or a reminder, maybe a text message, an email, a notice via mail, and just saying, hey, FYI, your loan payment is past due. Usually, the past due notices are pretty innocuous. It's just kind of informing you that the payment is past due. But that's the first kind of check mark or milestone in the delinquency process. The next step kind of happens starting at 31 days to 60 days. And that is often the time period where the loan will be considered officially delinquent. And at this point, the lender may issue a formal notice and say, this is your loan is officially delinquent. Or they may issue a demand payment that says, hey, you owe us last month's payment. And so it's going to be a little bit more formal letter or notice that they send to you. But when a loan is delinquent, usually no legal action is going to be taken, no drastic action will be taken. However, if the lender is reporting your credit history or your loan history to the credit bureaus, it will show up as a delinquent loan in your records. And then the final stage, again, typically is 60 days or 61 days past due. And that's when the lender can declare a default. And as I said earlier, when a lender declares a default, they have now actions that they can pursue or recourse that they can pursue to recover the funds that are owed to them. And in the last slide, we talked about some of the actions that they could take. They may take all of them, they may take none. That will depend from lender to lender, and we'll talk about that in a following slide. But they also may, at this point when a loan is default, banks often or lenders often have a department called special assets. And these means that, from from a lender's perspective, this asset is at risk. And so they send it to the special assets department, and these are folks that are they're specially trained and equipped to handle situations when a loan becomes a default. And that includes possibly renegotiating the terms of the loan, and we'll talk about that in a subsequent slide. So that's the typical process, past due, delinquent, default. And again, this is a broad generalization. Every lender will be very different in terms of how they approach this. So who the lender matters very much in terms of how aggressively they pursue this process. Most lenders are typically a bank or a credit union, and they will be typically more formal, and they will tend to stick to the letter of the loan agreement. And that's partly because they're regulated, and they have depositors that will need that's where their money is coming from, and in order for them to honor their commitment to the depositors, they need to take action relatively quickly to uphold that commitment, as well as to avoid regular scrutiny. And as I said earlier, they may have departments, special assets that deal with default. So expect a more formal approach to this when the lender is a bank or credit union. On the other hand, there are community lenders, and community lenders are typically nonprofits or government agencies that deploy capital for a mission or purpose-driven perspective. Yes, they want their money back, but equally important to them is to be able to support a community by providing capital to businesses in that community. And so they will tend to be more flexible and accommodative. They're going to be more willing to work things out and have more flexibility when a loan has experiencing repayment problems. Some may even have forgiveness options. There are lenders out there that may allow you to forgive, or they may forgive a portion of the loan under certain circumstances, whereas a bank or credit union will hardly ever do that. They're more likely to offer more time. So if they declare default, for example, they may not do anything right away. They may want to, kind of have a conversation with you and negotiate options and discuss options, or give you a little bit more time before initiating any action. And oftentimes the recourse, the things that they can do when they declare default is more so to get you to the table and keep you engaged as to recover the funds. Though, to be frank, if you're paying, games with them, if you're not showing up, if you're not being honest, they can behave like banks, and they can pursue legal action or, things that, to protect the interest that they have. So it's very important to be kind of, on the good with them, so to say, and, be upfront and honest. So the bottom line is that if you're a prospective borrower and you're concerned about aggressive recovery tactics, one of the things that you may want to do is pursue a loan with a community lender as opposed to a bank or a credit union. So what happens if you're delinquent or approaching default or in default? What do you do, and what do you not want to do? First, things that you don't want to do. You don't want to go AWOL. You don't want to disappear. I used to do lending, and occasionally we would have a business owner that just disappears. We can't get a hold of them. We don't know what's going on. That's the worst thing you can do. It's just important. I understand it might be uncomfortable to talk to them, but you want to be available and engage with them. Because if they don't hear from you, they're going to go immediately to the most drastic actions, and that often is not in your best interest. The second thing is, don't liquidate, hide, or do anything kind of with your collateral. You in your loan agreement, you pledged that collateral to the lender in the event that you can't pay the loan. And if you go ahead and liquidate that collateral or hide that collateral and make it less accessible to the lender, you're in direct violation of the loan. and so loan agreement. So you don't want to do that. And again, if they sense that that happens, they're going to immediately start pursuing court actions and the more aggressive tactics that are outlined in the loan agreement when a default occurs. And lastly, don't stick your head in the sand. Don't think that this will go away or whatnot. Acknowledge that this is a problem, and the best way of dealing with it is to be open as much as you can with the lender and try to address the problem and not hope that it will just go away. So some things that you can do, when you're in a delinquent your loan is do talk to your loan or bank officer, though not the call center. This is the person that you probably talked to when you were getting the loan. You have a relationship, you tend to have a relationship with them. It's a person, it's someone that you can meet in person. They know your business, they know a little bit about you. They can kind of vouch for you within their organization. And let them know what's going on. Tell them that you had a bad quarter, or some unexpected expenses came up, or the best is to be as open and honest as possible with them, because they are your advocate inside the organization, and they, depending on the lender, they may have some authority to renegotiate or alter the terms of the loan, which we'll talk about in a few moments. Another thing you can do is make partial payments. If your monthly payment is, for example, $1,000 and you can't pay it, pay $200, pay $50, pay $500, whatever you can afford. And that's really important because it demonstrates that you are personally committed to making the loan payments. That, yeah, you might not have the cash to make the loan payments, but you're still committed to it. And that goes a big way with lenders, or most lenders, I should say. And it often translates to giving you more flexibility if and when you have to renegotiate the loan. And opposite of don't stick your head in the sand, be responsive and accommodating as best as you can. Lender might say, okay, we understand the situation. Can you send us this report, or send us this receipt, or send us some documentation? Be proactive and provide that information as best as you can. Some things that you can consider doing, is one, restructuring, often referred to as a workout. And this basically is, renegotiating the terms of the loan payment. And this could be permanent or temporary. Permanent meaning that, instead of paying $500 a month for the next, 2 years, that is, in your loan payment schedule, you may be able to renegotiate with them and say, hey, we'll pay, $100 a month and spread it over 5 years. That will give you a little bit more cash flow flexibility and allow you to hopefully stick with the payment terms. The numbers that I just offered, are just off the top of my head, but it gives you an idea of what a permanent workout might be. The workout can also be a temporary workout, meaning that maybe things are slow this quarter and you just need a little break. So one thing that you could potentially work with them is says, hey, can we pay interest only for the next 6 months or 3 months or however long is needed? And then after the 3-month period or this temporary period, we would go back to the normal payments. That's a temporary workout. It's something that is only for a fixed limit of time, designed to help you get over, whatever immediate challenge that is in front of you. Again, different lenders have different approaches to permanent and or temporary workouts, but that's an option that you can have. Another option that you can consider is, swapping and liquidating high value collateral, of course, with the lender's permission. So what I mean by that is that, let's say you pledged a piece of asset that's worth $50,000, but you only have $20,000 that is remaining in your balance, a loan balance. Well, that means you have about $30,000 that is not really helping you or the lender. So if you have another piece of collateral that you can offer and swap it out, something that's worth $25,000, and swap it out with the high value collateral, the lender is still secured, but now you have an opportunity to tap into that extra equity, so to say, that you have, and maybe sell it, maybe use it to refinance a loan, which I'll talk about next. But it gives you some options and might be able to free up some cash so that you can make your loan payments or refinance your loan. And then the third option you can consider is just refinancing the loan, and that is getting a loan from another lender, or actually sometimes it could be for the same lender, to basically purchase out, pay off your existing loan that you might be having challenges repaying, and refinancing it and getting another loan that you would make the monthly payments with. That type of loan, the terms might be a little bit more friendly. They, maybe interest rates has dropped, and it's cheaper to do that. So that's an option that you can do, refinance a loan. So you pay off the loan that you're having trouble with and, start paying another loan. But I say with caution, because sometimes, if there's still a fundamental issue with your business in that it can't generate sufficient profits to repay the loan, then refinancing your loan is just kicking the can down the road, and you're going to encounter this problem at some point again in the future. And sometimes you might end up being more in debt depending on the interest rates or fees or other conditions of the loan. So it is an option. Consider it with caution, because you don't want to end up digging yourself in a deeper hole. A quick word about loan guarantees. Oftentimes young businesses get loan guarantees, and it's something that is offered often by the federal government, the SBA in particular, or the state government, and they do it for economic development purposes. And what they do is that they tell the borrower, they tell the lender, if the borrower can't pay, we'll pay a portion, we'll pay the majority, 85% of the outstanding balance. It's important to remember that loan guarantees protect the lender, not the borrower. So if the lender declares default, they can claim, they can ask for the guarantee. The lender is made whole, but the debt is actually transferred to the guarantor. So your debt to a third party, your debt in the loan, your outstanding balance in the loan still exists, but not with the lender. It goes to the guarantor. So if a loan guarantee is invoked, as I said, the borrower's debts gets transferred to the guarantor. The guarantor may put a lien or even garnish your assets, as a recourse, immediately. The guarantor may force a liquidation of assets. They might say, okay, your business is such that the best way for us to we'll honor the guarantee, but now that the debt is with us, we want you to liquidate your assets and use those proceeds to repay the balance that's been transferred to us. And the guarantor may also require a payment plan. And so oftentimes, the only way out is to either repay the guarantor in whole the outstanding balances that they initially covered, or to declare bankruptcy. And while that might be an option for you so that you don't have to pay the guarantor, there are also obviously some ramifications if you declare bankruptcy either for yourself and or your business. And these bankruptcies have long-term ramifications on your personal finances. So some preemptive actions that you can do to mitigate or reduce the risk, if one day you can't. So again, this is in advance. Things might be going fine at first, but things that you can do in advance to mitigate that risk. First is, when you're shopping for a lender, ask them out front, what happens if the loan were to be delinquent or default? It is totally acceptable question. It's like if you buy something and you say, what happens if it breaks? I know it's an awkward question. No one wants to think that the loan is going to be delinquent or default, but you have a right. And in fact, you have an obligation to yourself and your business to ask that question. And a reputable lender is going to give you an honest answer. And they're going to tell you, this is what happens. So at minimum, allows you to be prepared. It allows you to compare, if you're talking to multiple lenders, which one is more favorable to you. You might have one lender that says, well, we have a policy that if you're 30 days past due, it's going to go directly to the courts. That's not good. But if you're talking to another lender that says, we're willing to work with you, we're willing to restructure your loan as long as everything's on the up and up. That's obviously a much more friendly lender to work with. So before you sign any papers, you're already, kind of gearing to work with that other lender, the more friendly lender, in the event that your loan, doesn't work out. So use that information to make a more informed decision when you're shopping for loans. Another thing that you want to do, again, is, as I said earlier, consider getting a loan from a community lender. They just tend to be a little bit more friendly and negotiable. They may be a little bit more expensive, and the money may not flow as smoothly or easily. But generally, the community lenders are more flexible when delinquencies and defaults happen. The other thing that you can do is just be really super hyper focused about profits and growing your profits the moment you get the loan. You get the check from the lender, you invested in whatever you need to do it, and stay super diligent about making sure that you're generating sufficient profits to pay the loan. I've seen many times people get the loan, they buy their stuff, and they forget that they actually have to grow their profits in order to repay the loan. So be super diligent about growing your profits. And then a final thing that you can do is request, upfront, interest-only payments. And so maybe the first 6 months of the loan, say, hey, can we just do interest only? It's something that lenders may not offer right away, but they are, willing to consider. And that just gives you a few months of more flexibility, especially when you're just getting money. Maybe it takes 30, 60 days for your investment to start generating the returns. So it gives you some time, it gives you some flexibility to implement your investments and generate some cash so that you can begin making the loan payments, the full loan payments, after the interest-only period.